a figure that defies comprehension. $36 trillion. This is the weight of America's national debt. But it is still money owed. A common assumption points to China, which holds some $750 billion of that sum. Yet this is only one thread in a far more complex tapestry. China itself is submerged in its own ocean of debt, a tide rising past $18 trillion. So, who holds their promise to pay? Much of it resides with Chinese banks. But those very same institutions also own debt from the United States. And across the Pacific, American banks hold debt from China, from Europe, from nearly every nation on earth. The deeper one looks, the more entangled it becomes. A global hall of mirrors where every country is both debtor and creditor. The world, it turns out, owes a staggering $300 trillion, a sum triple the size of the entire global economy. If the world is in debt, to whom is it owed? The question is simple, but the answer reveals the strange kinetic architecture of our age. This is not an accounting error. It is a clue that the modern world is not built on stability, but on perpetual motion. It is a system powered by a never-ending cycle of borrowing, lending, and reinvesting. This is the story of how debt became the engine of civilization, and the silent question of what happens if that engine ever stalls. The idea itself is not modern. It is not a creature of spreadsheets and government ledgers. It is one of the oldest, most human of inventions. Long before the first coin was minted, before paper money was ever conceived, debt was simply a promise. A bag of grain lent to a neighbor in the spring, a pledge to be repaid when the harvest came, perhaps with a little extra as a gesture of gratitude. There were no contracts, no interest rates. There was only trust. For millennia, humanity understood a fundamental truth. Sometimes you need something today that you can only pay for tomorrow. At its core, that is all debt is, a bridge built to the future. Over centuries, these simple, personal promises evolved. Kings required castles. Empires demanded fleets and cannons. But no single lender could finance such ambition. In the 1600s, England confronted this very problem. King Charles II prepared for war against the Dutch, but the royal treasury was bare. The nobility refused to lend, and so a new idea was forged. The state began to sell pieces of its debt directly to the public. In exchange for cash, a citizen received a written promise of repayment with interest. It was called a bond. The innovation was simple, but its consequences were revolutionary. A state could now raise immense sums of money without resorting to ruinous taxes. By the 20th century, this mechanism had gone global. The crucible of the First and Second World Wars forced nations to borrow on a scale never before imagined, transforming a financial tool into the very circulatory system of the planet. And so we live within this grand design, a world built not on what we have, but on what we promise we will have, an entire civilization held aloft by a delicate, invisible network of trust. The constant motion is what keeps it from collapsing, but it leaves us with an unsettling thought. What happens if, one day, the lending simply stops? What becomes of a world built not on solid ground, but on the hope of a tomorrow that must always arrive. From the ashes of a world at war, a new order was forged. Nations mobilized on an unprecedented scale, not merely to fight, but to rebuild. In 1944, the Bretton Woods Agreement erected a new financial edifice with the United States dollar at its center. Currencies were tethered to the dollar, and the dollar in turn was tethered to gold. But this golden anchor had a fatal flaw. Gold was finite. The ambition of nations was not. As American spending surged, the vaults could no longer honor the flood of paper dollars circulating the globe. And so, in 1971, President Nixon made a fateful decision. He severed the link. The gold standard was no more. In that moment, money was fundamentally transformed. It became what we now call fiat currency, a promise backed not by a precious metal, but by government decree alone. The printing presses were unleashed now. Beginning in the 1980s, global debt began to explode. Nations discovered a powerful new tool. Borrowing was no longer a last resort for wartime. It could be the very fuel for economic growth, and so they borrowed. They borrowed to build schools, to pave roads, to pull entire economies from the brink of recession. Debt, once a specter to be feared, became the engine of progress. It ceased to be the exception and became the rule. Today, debt is the architecture of our world. It is how cities are raised, how crises are managed, and how political promises are kept. The result is a planetary mountain of obligation now cresting $300 trillion, more than 3 times the value of everything humanity produces in a single year. To comprehend such a figure is to grapple with the impossible. A stack of $1 million in bills would reach 100 meters, the height of a 30-story building. $1 billion would stretch 100 kilometers, scratching the edge of space. But $300 trillion is a column of paper that could travel to the moon and back 50 times over. This raises a profound question. If every country is a borrower, who precisely is the lender? If everyone is in debt, who holds the credit? It is tempting to imagine a shadowy cabal, a powerful few pulling the strings. But the reality is far more intricate. Modern debt does not move in a straight line. It moves in a circle. Consider the world's most indebted nation, the United States. The surprising truth is that roughly 70% of its national debt is owed to its own people. America, in effect, borrows from itself. The government issues bonds, a promise to repay with interest. And who buys these bonds? Very likely you do. When you deposit money in a bank, it does not sit dormant in a vault. The bank puts that capital to work, and one of the safest investments it can make is in the debt of its own government. Your savings, your retirement funds, the quiet capital of millions, are woven into this vast, self-referencing loop. The system is not one of a single lender and a world of borrowers. It is a complex web of interlocking obligations where we are all simultaneously debtor and creditor. It is an edifice built not on gold, but on a collective faith in tomorrow's promise to pay for today. A promise we have all in some way made to ourselves. Within the quiet architecture of finance, money is never at rest. It is put to work, channeled by commercial banks into a vast circulatory system of loans, investments, and government bonds. In the United States alone, these banks hold nearly $1.8 trillion in Treasury bonds, a sum that eclipses the entire economy. Bonds have become the bedrock of modern investment for a simple reason. They are among the safest harbors for surplus capital. Unlike the volatile swings of the stock market, they offer a promise of stability. The government, of course, retains the power to adjust the yields, using them as a lever to manage the economy. In the 1980s, to combat rampant inflation, rates soared above 15%. During the economic recovery of 2020, they were lowered to less than 1% to stimulate spending. But for the investor, the contract is sacrosanct. Once a bond is purchased, its rate is fixed, a guaranteed return insulated from the shifting economic tides. A 10-year United States government bond today offers a steady 4.5% annual interest, a compelling proposition for its near-zero risk. This fundamental security is the very source of its power. And so, it is not merely banks that seek this refuge. It is anyone who presides over a great pool of money. Pension funds, insurance companies, vast investment firms, all participate in the same ritual. In 2024, American pension funds committed a quarter of their entire portfolio to bonds. For insurance companies, the figure was even more dramatic. Over 60% of their assets, a reliable engine to grow their funds while mitigating risk. A hidden network emerges where the collective savings of a populace become the loan capital for its own government. The notion of a nation borrowing from itself ceases to be a paradox. It is simply a reallocation of resources, money flowing from corners of the economy where it sits idle to sectors where it is needed and spent. When the government pays interest on this debt, that capital flows directly back to the lenders, enriching the very pension and insurance funds that support the public. This newfound cash is then, in turn, used to purchase more bonds. It is a self-reinforcing loop, a vast circular river of capital moving from lender to borrower and back to lender again, powering the system with each revolution. This same mechanism operates on a global scale. Roughly 30% of American debt is held overseas. Foreign governments and internerves into the security of United States bonds. The logic is identical. Capital flows in when the nation borrows, and it flows out when it repays, in a constant rhythmic exchange. This is the universal language of modern economics. Every nation is a borrower, and every nation is a lender. The savings of the Japanese become loans for the Dutch. The reserves of the Dutch become capital for the world. It is a silent, intricate web of mutual dependence, a global balance sheet where the debt of one is the security of another, endlessly cycling in the great, unseen machinery of the world. The savings of a worker in Brazil do not simply rest. They flow almost invisibly across the globe, eventually finding a home in American government bonds. This is the hidden architecture of the world's financial system. Global debt is not a static mountain of unpaid bills poised to collapse. It is a vast circulatory system, an interconnected web where capital flows in perpetual loops from savers to borrowers and back again. Nations borrow, investors lend, and the river of interest payments keeps the entire machine in motion. While some of this wealth crosses borders, most of it never truly leaves. It merely changes its form, changes hands, and continues its endless journey. The question then arises, if a government borrows endlessly to fund its present, how can it possibly repay the debts of its future? The answer is as simple as it is unsettling. It borrows more. New debt is summoned into existence to pay for upon which the global economy is built. And so, the system churns onward. But why does no one stop it? Because we have reached a point of no return. Our economies, our politics, our very way of life are now constructed upon a bedrock of borrowing. The uncomfortable truth is that debt fuels growth. When a government borrows and spends, it injects lifeblood into the economy. Money circulates, businesses expand, workers are paid, and with money in their pockets, they spend more. It is a powerful feedback loop, driving expansion, promising that everyone in the end can be better off. In China, 19% of all government expenditure is financed by debt. 1 in every 5 yuan spent is borrowed. In the United States, the figure is higher still. Roughly 1 in every $4 the government spends is new debt, an amount equal to its entire budget for education and welfare combined. To halt this cycle would be to reverse the engine of prosperity. If a government were to suddenly stop borrowing, it would be forced to spend less. The flow of money would cease. Businesses would earn less. Workers would lose their jobs. And without an income, they would stop spending. The very same loop that created growth would be thrown into a devastating downward spiral, leaving everyone worse off. We have salt-struck, panic swept through the markets. Investors, suddenly fearful of risk, stopped buying Greek bonds. Cut off from its ability to borrow, the nation ran out of money. 1 in 4 public workers were dismissed. Wages plummeted by 30%. Over the next few years, the Greek economy shrank by a staggering 25%. This is the lesson that haunts the halls of power. Politicians know it. The people know it. Everyone demands that the government keep spending, that the economy keep growing. No one wins an election by promising austerity. And so the spending continues. The borrowing becomes inevitable. Yet, it is not always about growth. Sometimes it is about survival. When a crisis hits, as it did with the pandemic in 2020, people stop spending. The economy shudders. In that moment of paralysis, the only way forward is for the government to step in, to borrow on a massive scale, and to spend the money that private citizens cannot. We have engineered a world that must borrow from the future to sustain the present. It is a system built not on assets or gold, but on a collective faith in tomorrow, a belief that the growth of the future will always be great enough to pay for the debts of today. In a time of crisis, when the lifeblood of tax revenue runs thin, nations must borrow. In the year 2020, the United States government borrowed an astonishing $3.8 trillion, a sum equivalent to nearly 20% of its entire economy. It was not a loan. From China to Europe, every major economy did the same. It was not a choice, but a necessity, born of a world standing still. Yet every loan is a promise made to the future. And if a government is already spending every dollar it collects simply to maintain the present, a fundamental question arises: from where will the money come to repay the debts of the past? The answer is a paradox of modern finance. To pay what was borrowed, they simply borrow again. A vast rolling cycle of debt that never truly leaves the system. For them, their bonds are seen as sanctuaries of safety, allowing them to borrow at vanishingly low rates, making the cycle almost frictionless. But for the developing world, the story is starkly different. Higher borrowing costs act as a constant drag, each rollover more expensive than the last. Over time, the debt begins to feed trap, forced to take on new loans not for progress or prosperity, but merely to service the interest on the old. And so, when the question is asked in America, why can we not simply stop borrowing? The truth is laid bare. We cannot. The same obligations that weigh the nation down are the very pillars upon which its economy was built. This reality forces an uncomfortable thought into the light. How long can this continue? Beneath the smooth surface of the cycle, profound risks are gathering. These are the risks that leaders avoid mentioning, that populations do not wish to face. As the debt grows, so too do the interest payments. A larger and larger slice of the national budget is diverted not to new schools, hospitals, or infrastructure, but back to the lenders of yesterday. A debt-to-GDP ratio approaching 100% is now considered normal, a figure that only decades ago would have signaled catastrophe. The entire edifice rests on a single, fragile foundation: confidence. As long as borrowing is cheap and lenders believe they will be repaid, the system holds. But that belief is all it is. Should investors begin to doubt, the cost of borrowing can shoot upwards overnight. Faced with this threat, governments have a powerful and dangerous tool. They can create more money. Price. As more currency floods the system, the value of each individual unit erodes. The result is inflation. Prices rise. The worth of a lifetime of savings shrinks, and a quiet sense of poverty spreads. In its most extreme form, the spiral becomes uncontrollable. In the Venezuela of the late 2010s, the government printed money with such abandon that the price of goods began to double every few weeks. A loaf of bread that once cost 10 bolivars soon cost millions. The very concept of money, of a stable measure of value, dissolved into thin air. We have constructed a global economy on a promise that the future will always be able to pay for the present. The cycle continues, the numbers grow larger, and the system becomes ever more dependent on its own momentum. The ultimate question is not whether the debt can be sustained, but what is being eroded in the process. And what happens when the faith that holds it all together finally breaks. It begins as a quiet erosion, then a catastrophic collapse. A currency, the lifeblood of a nation's commerce, becomes nearly worthless. Life savings, the accumulated labor of generations, vanish overnight. While few witness such an extreme unraveling, even moderate inflation presents a creeping danger, a slow bleeding of value from the money in one's pocket. For many developing nations, the risks are magnified, tied to a precarious dependency. They often borrow in security. But this security is a double-edged sword. If their own currency weakens, the debt, measured in local terms, suddenly swells. As this burden grows, a shadow of doubt falls upon the nation's ability to repay. The mood shifts. Investors, once eager, now demand higher interest rates to compensate for the perceived risk. The government finds itself in an impossible position, unable to borrow. How does it honor its old debts? Does it slash public spending, levy punishing taxes, or does it turn to the printing press, creating more money and feeding the very inflationary fire that threatens to consume it? There are no easy options, only choices with severe and lasting consequences. Even then, there is no guarantee that these painful measures will generate enough to keep the state solvent. Eventually, if the money cannot be found and the bills come due all at once, a country runs out of road. This is the moment of default, a stark admission: we cannot pay. It is the sovereign equivalent of missing a mortgage payment, but the asset at risk is not a single home, but the entire economic architecture of a nation. In the chilling silence that follows, the government cannot simply borrow its way out. Trust has been broken. No one wants to lend to a defaulter. When a system built on debt becomes so fragile, people begin to search for something real, something tangible. It is a flight to safety we are witnessing now. Record sums are flowing into gold. The metal has surged nearly 28% in a single year, while the dollar has faced its own significant volatility. Mining stocks have made staggering moves, with key indices rising by nearly 45%. Even the world's most powerful banks are making bold pronouncements. J.P. Morgan sees gold reaching $4,000 by mid-2026, a sentiment echoed by Goldman Sachs and Bank of America. This renewed faith in a physical asset traces back to its source, the earth itself. Vast portfolios of gold and copper resources are being mapped across the Americas. In pro-mining jurisdictions from Canada and the United States to Brazil, Colombia, and Peru, geologists have identified immense deposits. We speak of some 12.4 million ounces of gold equivalent in the measured and indicated categories, with a further 9.1 million ounces inferred to be waiting beneath the surface. It is a profound return to first principles, a quiet reminder that when the abstract symbols of wealth begin to falter, humanity has always sought its bedrock not in promises, but in the enduring elemental certainty of the earth. In the digital age, gold remains an ancient anchor, its price soaring against the tides of uncertainty. Yet, a curious paradox has emerged. While the metal itself gleams with record value, the companies that pull it from the earth often linger in the shadows, their worth strangely disconnected from the very treasure they seek. Within this landscape, certain entities defy simple categorization. One such company, Gold Mining Incorporated, is more than a collection of mineral properties awaiting development. It is a financial fortress, holding a portfolio of publicly traded equities that, by the 5th of June, 2025, was valued at more than $150 million. This figure alone surpassed the entire market capitalization of the company itself. Added to this was a reserve of $6.8 million in cash, a balance sheet stable from its last reporting on February 28, 2025. The implication is profound. The market had assigned no value, or perhaps even a negative value, to its vast underlying gold projects. This anomaly exists against a backdrop of immense industry pressure. For the titans of mining, a silent crisis looms: reserve replacement. Every ounce extracted must be replaced, but new high-quality discoveries are becoming vanishingly rare. The giants must now look to acquire, to absorb smaller players with promising assets bored. Guiding this strategy is a confluence of industry veterans, men who have previously commanded the world's largest gold corporations, from Goldcorp to Newmont, alongside serial entrepreneurs who have built mining empires from the ground up. Their conviction is not merely spoken, it is underwritten by their own capital, with insiders holding over 10 million shares, their personal fortunes tied to the company's fate. Their belief is echoed by a constellation of the world's most powerful financial houses: Ruffer, BlackRock, Sprott, Morgan Stanley, UBS, Goldman Sachs. These are not speculators, but institutions that move markets, and their names appear as key shareholders, a silent consensus of quiet capital. In the relentless search for tangible wealth, value can become a matter of perception. It can lie dormant, obscured by the noise of the present, waiting for the long-term view to prevail. For in the world of gold, the ultimate prize is not always what is pulled from the ground, but the patience to recognize what others have overlooked.